This is Taking Stock on Bloomberg. I'm Pimm Fox. My next guest says the easy money, it's already off the table. And his advice, do not make decisions based on what's called the flight to safety or the flight to yield mentality. Yu-Dee Chang is the president of ACE Investment Strategists, and he joins us now. Yu-Dee, welcome to the program.
Thank you. I'm glad to be here.
What do you mean by this idea of don't make investment decisions based on, let's say, the flight to safety or the flight to yield? What do you mean by that?
Yeah, that's a good question. Basically, we had a really fallout back in 2008, and from there, everyone really got scared and saying that, you know what, this may be a good investment, this may be something I should do, but I'm scared, I don't want to do anything. And then market stabilized in March, May of 2009, and everybody started to jump back into the market saying, boy, if I don't start investing, I'm going to miss this opportunity. So what should I invest? Well, what's performing? Gold, let me buy some gold. Stocks, let me jump into the stock market. I think all that is over. It's like a rubber band effect. We got a little bit overstretched to the downside, and then when we had a huge bounce back, it got a little bit overdone to the upside. I think investors should go back to the basics and go back to more of a reality.
All right, now more of a reality. The reality was pretty real today when you take a look at what happened in the stock market. The Dow Jones Industrial Average down 213 points. Does this change any of your outlook in the market right now?
No, Pimm. If you think about it, I think going forward, to me, it's actually pretty clear on a slightly intermediate term basis. Day to day, of course, you're always going to see volatility, abrupt swings. But over the intermediate term speaking, if you look at all the data, it is showing us that the economy has made a bottom, it has stabilized. However, the data is also showing me that we're definitely not going to have a very robust recovery. Thus, the market is probably going to do what it has been doing for the past 6-7 months. Probably a very slow uptrend with abrupt, well, every now and then with some so-called corrections.
All right. And in the areas that you're focused right now, technology as well as healthcare, are those the sort of sweet spots for the market right now?
I think so going forward, too, and there's reasons for it. One, technology. These companies have a lot of cash on hand, and also these companies are a little bit less subjective to the tight credit. So when the economy does turn, they will be sitting there reaping the benefit of it. That's one. Healthcare. Whether this Obamacare goes through or not, it really has nothing to do with that per se. But, Pimm, I'm a so-called baby boomer. I'm starting getting old. So my eyesight's going a little bit, my hair's falling out a little bit. So I think
you're doing all right.
So I think going forward, our generation happened to be one of the larger generations in the history. So going forward, that's why I believe healthcare related, whether it's biotech, whether it's hospitals, are the sectors that an investor should really pay attention to.
All right. Now, in these two sectors, though, is there a point at which you say, you know what, things are just too expensive? I'm going to wait for an even greater pullback in stocks before I start deploying some capital, or is now the time to be doing it?
You know, my investors should invest some of their money with you, too. That's exactly the point. Just because we like healthcare, just because we like technology, that doesn't mean we should go out and jump out and buy it today. That's why we're a true believer that maybe using fundamentals to assess, to see whether we should be buying, but the timing part of it is most important. You're right. Just because we like it, it really doesn't mean we should go out today and go buy it. Like right now, if you look toward to 2009, we're projected to have a 2.7% GDP. No inflation, about 1.7%. However, the market multiple is getting to be a little bit more expensive. Right now, on a trailing basis, it's approaching about 24 or so. So to me, right at this second, it's probably not a time to make a long-term investment. You probably would like to wait the market to go through a little bit of correction, to settle down a little bit before you go in.
All right. Now, as someone who knows how to trade both in and out of the market, I'm sure you're paying attention today to the proposals by President Obama to limit the proprietary trading at various large banks. What's your reaction to that?
Well, basically, I think I'm in agreement with it. Last time, basically, President Obama is coming out and saying that, you know what, we don't want you to take this kind of risks, which might jeopardize the broader economy. I think as of yesterday, 4 of the major banks still holds about 60% of the U.S. deposit base. So that's too much risk for them to take with their proprietary trading. So the president is saying that, hey, as a commercial bank, you make your choice. either you want to be a commercial bank or you be a brokerage firm or an investment bank, but we're not going to allow you to do both. So I think it's probably not a bad idea. Last time, believe it or not, we actually had this. We had this so-called regulation/law from 1933 to 1999. 1999 is when they repealed it. And look what happened after that.
Right.
So I'm kind of in agreement with it.
All right. I thank you very much. Yu-Dee Chang coming in, the president of ACE Investment Strategist, giving us a look in terms of IT as well as healthcare.
Thank you very much.
Appreciate it.